Right now, gold is trading at $4,350.59. I'm going to give you a number that nobody is talking about. $4,357. That is the 200-day moving average, and we are closing below it on the daily chart for the first time in 3 months. Most retail traders are staring at the oversold RSI on the 1 hour, convinced a bounce is imminent. But institutions are reading a completely different story, and if you're on the wrong side, this week's CPI could turn your account into a liquidation statistic. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade. Here is your instant market verdict for gold this session. The bias is strongly bearish across the 1 hour, 5 hour, and daily timeframes. We are in a trending decline, not a range. Sell rallies, do not buy dips blindly. The only thing keeping this from a full-scale freefall is the monthly chart, which remains a buy structure above $4,200. That's the long-term safety net, but it's not your friend if you're trading with leverage this week. The single invalidation level that flips the intraday bias, $4,384. Write this number down. If we get a 4-hour close above $4,384, the bearish structure is broken and we must respect a short squeeze toward $4,416. Until then, every pop is a reload for sellers. Here's what the herd is doing right now. Retail sentiment has flipped wildly bearish after last week's near 5% drop, with small speculators piling into fresh shorts. Under $4,360. That's exactly where institutions love to engineer a sharp, violent bounce to shake out weak hands before the real move lower. So while I am structurally bearish, I am also waiting for a liquidity grab above $4,380 before committing size short. Patience is your edge. Let's walk the charts from the weekly down to the 60-minute, because the moving averages are telling a brutal story. On the weekly, gold has printed its 4th consecutive lower high, and the 20-week moving average, currently around $4,515, is curling down with authority. The MACD on the weekly is deep in bearish territory, with the signal line accelerating below zero. There is no divergence yet, meaning momentum is still building to the downside. This is not a market trying to bottom. This is a market trending lower with conviction, now dropped to the daily. Price has sliced through the 50-day moving average at $4,637, the 100-day at $4,608, and the 20-day at $4,515 like a hot knife through butter. The only major daily moving average left standing is the 200-day at $4,357, and we are trading right at its throat. The MACD on the daily is minus 70.66, with no sign of a bullish crossover. The bull-bear indicator is minus 238, which quantifies exactly how dominant the selling pressure has become. Here's what most traders miss. The 200-day moving average is not a support. It is a magnet and a battleground. When price approaches it from above after a steep decline, the first touch almost always produces a violent reaction. But not necessarily a reversal. Often, it's a fake-out, a trap that sucks in counter-trend buyers, only to break lower and accelerate. That is the scenario I'm most focused on, now the 4-hour chart. This is where the hidden divergence lives. The 4-hour RSI is at 33.89, not yet oversold, but the stochastics have turned up slightly to 40.6 while price is making marginally lower lows. That's the earliest whisper of a bullish divergence in the making. It's not confirmed. If price pushes below $4,321 and stochastics roll over, this signal dies. But if stochastics continue to climb while price holds above $4,321, we could see a quick $30 to $50 short squeeze. The 4-hour MA20 is sitting at $4,405, far above us, and it's acting as dynamic resistance. Every time gold has tried to rally in the last 72 hours, that moving average has capped it. The ADX on this time frame, from the data we track, is reading 51.5. That is an exceptionally strong trend reading. Trades against this trend are gambling unless you have a scalpel sharp entry and a stop loss measured in single digits. Finally, the 60-minute chart gives us the tactical map. The SuperTrend indicator is flashing red at $4,384.10, which aligns beautifully with our $4,384 invalidation level. Price is currently hovering inside what I call the no-trade swamp between $4,310 and $4,360. Entering here is a coin flip. The 60-minute RSI dipped to 29.9 recently, and we saw a hammer candle form at $4,293.45. A hammer in an oversold zone after. A waterfall decline is a yellow flag for sellers. It indicates exhaustion. But a single candle does not confirm a reversal. We need a 1-hour close above $4,360, ideally with follow-through above $4,375, to turn that hammer into a genuine bottoming signal. Until then, it's just a trapdoor waiting to break. Here is your daily support and resistance grid. I want you to memorize these levels. Immediate support is $4,344, followed by $4,321, and then the major demand zone at $4,308 to $4,293. Below that, the door opens to $4,230 and eventually the psychological $4,000 handle. Resistance starts at $4,380, a cluster of the SuperTrend, the 1-hour Ichimoku cloud base, and recent swing highs. Above that, $4,393 and $4,416 represent the next supply zones where sellers will defend aggressively. Now, cross-asset linkage is screaming at us. Gold is moving tick for tick with real yields collapsing. Wait, real yields are not collapsing, they are surging. The 10-year real yield has punched through 2.6%, and that is kryptonite for a non-yielding asset like gold. Simultaneously, the dollar index is extending its rally, driven by widening rate differentials and safe haven flows from the Middle East escalation. That's a double headwind. And yet, oil prices spiked this morning on geopolitical fears, which normally would support gold as an inflation hedge, but the correlation has broken. Gold is decoupling from its traditional role and trading purely as a yield-sensitive asset right now. That tells us this move is institutional, not emotional. What changed in the last 24 hours? Overnight, we got fresh headlines that Israel and Iran are pursuing an immediate ceasefire, with President Trump stating final negotiations are proceeding. Oil paired gains, but the dollar held firm. That kept gold under pressure even as geopolitical risk seemed to ease. Normally a de-escalation would hurt gold, but the dollar bid from rising rates overpowered everything. At the same time, the market is pre-positioning for this week's CPI print, with whisper numbers suggesting core inflation remains sticky around 3.1%. If CPI comes in hot, expect the dollar to rip higher and gold to test $4,230 rapidly. If CPI misses, we could see a sharp bond rally, yields dropping, and gold squeezing shorts up toward $4,416. That's the binary event that shapes the next 2 weeks. My directional lean for the next 1 to 2 weeks remains lower, targeting a retest of the $4,230 zone, with a stretched downside target of $4,000 if dollar strength accelerates. The event that would invalidate this bearish outlook is a daily close above $4,416 combined with the 10-year yield breaking back below 2.4%. Until that happens, I am selling rallies. Do you think gold breaks below $4,300 before CPI? Comment yes or no. I'm tracking consensus right now, and I'll reference the results in tomorrow's breakdown. Most people skip this section. That's exactly where the money is made. Keep watching. I'm about to lay out 3 precise trade plans, with exact entries, stops, and risk-reward ratios. These are not vague ideas. These are the same levels I have placed on my own watchlist. Strategy 1, the sniper, conservative. This setup waits for a confirmed bounce failure at resistance. Here's the logic. We are in a strong bear trend, and the highest probability trade is a short from a level where buyers get trapped. We need price to rally into the $4,380 to $4,384 zone and show rejection. A 1-hour candle close below $4,378 after spiking above $4,380 is ideal. The stop loss goes above the recent swing high at $4,395, which sits just above the resistance cluster. Take profit 1 is at $4,344, the first support, giving a risk-reward of 1 to 2.4. Take profit 2 extends to $4,321, pushing the ratio to 1 to 4.3. Invalidation. If the 4-hour candle closes above $4,395, the setup is void. We do not chase lower. We step aside the sniper, conservative, entry. 1H close below $4,378 after tap of $4,380 $4,384 stop loss. $4,395 take profit 1. $4,344 take profit 2. $4,321 risk, reward. 1 minute and 2.4 seconds 1:4.3 invalidation. For H close above $4,395 strategy 2, the active trader, standard plan. This is for traders who want to participate in the momentum without waiting for a deep pullback. We will sell a break of the $4,344 support level, which is the current swing low. The trigger is a 15-minute close below $4,343 with RSI on the 15-minute also breaking below 30, confirming momentum. Stop loss is placed at $4,362, just above the top of the recent consolidation zone. Target 1 is $4,321, and target 2 is $4,308. Once target 1 is hit, move your stop to break-even and trail by $15. Risk-reward on the first target is 1 to 1.2, tight, but high probability. The second target pushes it to 1 to 2.8. This setup leverages the breakdown momentum. If the break fails and price reverses back above $4,360, we cut losses immediately to the active trader, standard, entry. 15M close below $4,343 stop loss. $4,362 take profit 1. $4,321 take profit 2. $4,308 trailing stop. Move to break-even after TP1. Trail by $15 invalidation. 1H close back above $4,360. Type your gold range for tomorrow in the comments now. What's your high and low? Let's see who's aligned with institutional flow strategy 3. The aggressor, high risk. This is a counter-trend bounce play off the oversold 1-hour RSI and the hammer candle at $4,293. It's designed for traders who can tolerate a tight stop and are willing to be wrong fast. Entry is a 1-hour close above $4,360 after RSI has already reset from sub-30. This signals that the bounce is gaining traction. Stop loss is placed at $4,343, just below the breakout level. Take profit 1 is $4,380, right at the SuperTrend resistance. Take profit 2 is $4,393. Risk-reward on this trade is 1 to 1.2 for TP1 and 1 to 2 for TP2. Not blockbuster, but the win rate on these oversold bounces in strong trends can be deceptively high if you time the exit precisely. Critical warning. If price fails to close above $4,360 within the first hour of the trigger attempt, exit immediately. Only for those who can lose small and manage risk aggressively. The aggressor, high risk, entry. 1H close above $4,360 after RSI reset from sub-30 stop loss. $4,343 take profit 1. $4,380 take profit 2. $4,393 risk, reward. 1 minute and 1.2 seconds 1:2 invalidation. No 1H close above $4,360 within 60 minutes of setup risk management pulse. Never risk more than 1% to 2% of your account on any single trade. No positions through high-impact news events, especially CPI. Stops are non-negotiable, hard stops in the market, not mental stops. This is how you survive to trade the next big move. Gold will give you plenty of opportunities, but only if your capital is intact. Here is the single most critical level for the next session. $4,357, the 200-day moving average. If we close the daily candle below this level, expect an acceleration toward $4,293 and $4,230. A daily close above it, and we must respect a short squeeze toward $4,416. Tomorrow's wildcard is the US CPI report. Pre-release positioning will likely drive a fake-out move 30 minutes before the data. I'll be watching the 10-year yield and dollar index correlation in real time. If CPI misses, gold could explode higher by $80 in 60 seconds. If it beats, the floor drops out. That video breakdown on Bitcoin and S&P 500 divergence is live right now. Tap the end screen because the risk asset shadow is setting up a massive move tied to these exact macro forces. Smash like if this gave you a clear plan for gold. Subscribe. Hit the bell, and I'll see you in the next one.